Congratulations! Your loan is conditionally approved. A SunWest loan originator is always on top of her approvals, no matter where she is. Break free with Morgan.
Welcome to The Interest. I'm Katie Jensen. Well, that didn't take long. My college basketball bracket fell apart midway into the first day. Bank executives and government officials are still scrambling to make sure the same doesn't happen to our banks. Everyone's trying to figure out how to make sure consumers have confidence in their bank without bailing out executives who made bad decisions. Now it's First Republic getting $30 billion in help from other major banks looking to avoid another collapse. Will we see Congress step in and help? And how is volatility impacting the mortgage industry? Our own Sarah Wolak has more.
Because it's classic interest rate risk. It was not well managed by Silicon Valley Bank, and they paid the price.
The collapse of Silicon Valley Bank is still causing waves in the economy. Bond volatility is at its highest rate since the 2008 financial crisis, and some consumers are worried about their own accounts. But for the mortgage industry, it means investors are turning to securities as a safe option.
We have seen the bond market rally, and so we have seen an improvement in mortgage rates.
But there's also questions about how we make sure people continue to have faith in banks. Experts seem to agree regulations aren't likely because Silicon Valley's collapse seemed to be a combination of its unique customer base and not doing enough to protect itself against rising rates.
Most of American banks don't face that kind of really large withdrawal pressure on a day-to-day basis.
But we could see increases in depository insurance to help avoid panic among account holders. The current FDIC limit is $250,000.
I think that confidence in our banking system is a bedrock of our economy, and so if people lose that confidence, what you do see is run on banks.
Many in the mortgage industry also want to see the Fed stop its rate hikes when it meets on Wednesday. Silicon Valley suffered losses when it had to sell securities, including ones backed by mortgages, to meet withdrawals. When it reported those losses, account holders panicked.
The Fed's increase in the rates is one of the contributing factors here in terms of the turbulence in the banking industry.
But not everyone agrees. Some remain confident that the banking system will stabilize and Silicon Valley Bank will be an isolated incident. Raising rates could hurt the momentum for mortgage-backed securities, but some say inflation still has to be the Fed's primary focus.
I think the Fed should stick to its guns.
For the Mortgage News Network, I'm Sarah Wolak.
Thanks, Sarah. Just today, we saw SVP Financial Group, the former parent company of Silicon Valley Bank, filed for bankruptcy. Meanwhile, some homebuyers may be benefiting from interest rate relief, partly caused by the volatility. Mortgage applications jumped for the second straight week as rates have fallen, according to Freddie Mac. The average rate for the 30-year fixed is down to 6.6%. And then there's this nugget from Redfin. Their mortgage company, Bay Equity, saw more rate locks on March 10th than any other day this year. This shows that buyers are still waiting for their chance to get a home, and they'll act quickly, whether it's rate drops or some other situation that's good for them. Redfin also says the median sale price fell by 1.2% in February, according to Redfin. The combo of dropping rates and sliding prices is music to buyers' ears. Coming up, independent mortgage bankers have their worst quarter in more than a decade.
Tired of turndowns and wasting 25 basis points or more on slow and manual loan processing? Divorce your processor and break free with Morgan Chat AI. There are no bad deals or tough loans, only deserving families that need AI-driven fast and accurate service. We treat every client fairly and with empathy. AI that understands how you feel.
I am Morgan. I get you.
Welcome back. We all know originators are struggling right now to drum up business, but independent mortgage banks are turning in performances we haven't seen in over a decade. The MBA says that independent mortgage bankers and mortgage subsidiaries of chartered banks had an abysmal fourth quarter, reporting a net loss of $2,800 on each loan they originated. That's a loss of 99 basis points, which the MBA says is their lowest mark since late 2011. The MBA says this is at least partly because production costs have reached their most expensive level since the association began tracking the data. You can get a full breakdown of the report at nationalmortgageprofessional.com. In other news, Sterling Bancorp Thursday admitted to swindling investors out of $69 million through securities fraud. Michigan-based Sterling agreed to $27.2 million settlement. That's the most the Justice Department could seek under inability to pay guidelines. The DOJ says Sterling was originating mortgages rife with fraud to pad its bottom line, and then lied about those loans in its 2017 initial public offering. The company continued the fraud in filings through 2019. In a statement Thursday, Sterling says it accepts responsibility. It also notes the officials responsible are no longer with the company. We'll be right back with what else is interesting today. Welcome back. Here's what else is interesting today. loanDepot was one of the account holders that had to move quickly to avoid losses in the collapse of Signature Bank. The company withdrew $225 million after Signature's closing Sunday. loanDepot reported the transaction in an SEC filing Wednesday, but the struggling lender can't completely cut ties with Signature just yet. loanDepot has warehouses and mortgage servicing rights agreements with Signature, each with a value of $300 million. Both contracts expire in September. For more on these and all of today's top stories, go to mortgagenewsnetwork.com.